Good afternoon, guys. Today we're going to be going over the HIMS and HERS earnings call and report. The earnings report just dropped here right now. I've gone over it already, so I'm just going to give you guys my thoughts. Be as transparent as possible with you guys. Let you guys know all the details that I'm seeing that are pointing out at me. Anything that I think is noteworthy, anything like that at all. So obviously we've seen HIMS and HERS has been growing steadily over the last few quarters. But these numbers I really think blew away all the expectations that we've seen in the past. Revenues up nearly 50%. Subscribers are growing double digits, and they're proving that the market can really be profitable at scale. This is a crucial thing that I think we haven't seen very much so, and I think that's why the stock is skyrocketing right now. This is one of those earnings reports that makes you rethink the whole stock, because they're not just talking about like, oh, this, that, the third. It's really execution. So let's unpack some of the numbers I'm seeing here. Just for a quick refresher, if you're new here, HIMS and HERS does direct to consumer healthcare, and they're one of the biggest companies right now inside of the U.S. market, and they're continually growing, and they have great margins. They have all this other stuff that I will get into here very shortly. And let me just pull one thing up. I'm sorry about this, guys. It'll take 1 second. One second. I'm sorry. All right. So the first thing I want to point out when I was looking at this earnings is the headline numbers. Obviously, we see the HIMS reported 598.98 million in revenue for Q3 2025, which is up 49% year over year from about 402 million last year. That's a massive jump for a company that's already doing half a billion a quarter. Nearly all of that, around 589 million of that came from online sales, which is one of the main things I want to point out to you guys here. The online sales are growing very quickly, and I think obviously we all know everything is moving online in the future, and this is their bread and butter. So retail partnerships are a small but growing part of the business, but the thing I want to focus on is how fast the online market has grown, and the fact that there are how did I see it right? Yeah, 2.47 million active subscribers is something very understated, and it's up nearly 21% from roughly 2 million last year. That's one of their biggest strengths right now. Not only are they adding users, but those users are sticking around, as we've seen. As also, what I think I want to point out is the average revenue per user. Where was it? I think, where was this? ARP. I can't find it. I was looking at the report in just a second. The average revenue per user was absolutely massive, though, and I think it's something that people aren't going to be pointing out, but I think it's why the stock will grow and it will continue to grow. It has jumped from nearly $67 to $80, as we've seen here, and that's about an 19% increase. For each user, they are making a lot more. Oh wait, it's right here. I was right in front of me, and I was looking all over for it. The average earned revenue per user has increased 19% year over year, which is absolutely massive for a company like this, and it's showing that it is going to continue to grow in the future, and that it is on a crossroads where if they can continue to extract more money from each customer, this company will grow very quickly, especially with how high the margins will be. $80 a share, I can agree with that. I thought it got beat down very hard. I was saying earlier, I made a video a week ago saying that this is the most beat down stock on the market, and I think it is going to correct soon, and we will see an explosion. So I think today's our day. We're finally going to see that, and I think the stock should be 50 by tomorrow morning. I still got to talk about more of the numbers, but I hope you guys hear me out here. So the average revenue per user jumping up 19% means that existing customers are spending more per month, either by upgrading their prescriptions, adding services that they previously didn't have, or moving into new categories like the weight loss meds, our skin care that they're doing. And it's just going to be a continually revolving door. And it's a very scalable model. When growth comes not from just more users, but from deeper engagement with the users you already have. This is one of the best things companies can do. Instead of growing, we don't need 200 million customers. We don't need all of America using HIMS and HERS. We just need the customers we have growing at exponential rates and you spending more on the site. And this is exactly how telehealth becomes a profitable business. You build trust with customers, they stay inside of your ecosystem, and their lifetime value compounds over time, over a multiple time of years. So while the subscriber growth is solid, the ARPU growth is what really drives the story here, in my opinion, for this type of company. It should be 100 by the end of the year. I agree completely. It went up to 70, I think, earlier in the year, and then it kind of fell off for no reason due to I'm pretty sure it was the Ozempic, other companies taking the Ozempic away and different stuff like that. But it hasn't really materialized into anything. And as we can see, that the stock is doing still pretty well. It has had a couple rough months, but I think it will rebound from here, and I think we will see in the future they will continue to grow, especially as we've seen profitability. Profitability, HIMS reported 78.4 million in adjusted EBITDA. Where was it? I can't even find it now. But they reported 78 million in adjusted EBITDA, which is up sharply from 51 million last year. Now that's not like something you could just write off. It shows that there's real margin expansion. It shows that HIMS grows, their cost structure is getting more effective. Gross margin did slip slightly from 79% to 74%, but that's completely fine for this stage of growth. They are spending a lot to scale new product lines. You got to think about how hard it is to develop some of these products and advertise them at scale and grow them into a large market product. Not only this, especially they've been investing a lot of money into the weight loss products, which I think will be very crucial in the next stage of this company. Not only this, but they also have the new mental health offerings, and they invest in the brand reach, which I think are important, and it shows that they're scaling while staying profitable on an adjusted basis. For years, investors were very how do I say it? They were pretty skeptical that telehealth could ever reach that point, that maybe the model just didn't work, but this quarter really proves otherwise. HIMS is showing operating leverage. Every new subscriber costs less to serve than the one before, and that just shows you a very profitable subscription business that will continue to grow in the future at fast rates. This call starts at 5, I think, but I'm pretty sure. Explosive growth, revenue surge, 49% year over year, 800. Yup, showcasing exceptional demand. Yeah, I agree, man. The stock is has been doing well, and I want to kind of break that down here. Where's cash? I want to point out the cash. Where is it? There you go. So cash. One thing I always look for in these types of growth companies is cash flow. Not just revenue or adjusted profit, but how much cash is actually coming in. And HIMS really crushed it here too. They generated 148 million in operating cash flow this quarter, up from 85 million a year ago. That's almost a 75% jump in cash generation. That's not something you usually see from companies growing this fast. Most of the time you see the opposite happening, especially in telehealth. You see a lot of cash burn, a lot of cash intensive business marketing. Whereas we see here, HIMS has really refocused the company, and they're generating a lot of cash, which is going to allow them to continue to stay at a positive cash flow, and it will allow them to expand product categories, which tells me that this is a self-funding growth story now, and we're not just relying on dilution or debt or anything like that. Bullish, hey, what's up, Gabe? It's nice to see you in the chat. Rob, did you see Navidius? Let me check. I didn't check it. I was calling it out earlier in the week, saying I think it was a good stock. Let me just pull it up here. Oh, we have seen a drop. Oh, you guys can't even see it on the screen. Down 12%. It's tough to say for a small company like this. I think it's just the time to buy more shares, and I think more partnerships are in the ropes for that company. But Are you going to stream the earnings call? Yes, I will be streaming the earnings call. I'm just waiting till 5 o'clock. I'm pretty sure it's gonna start. I'm already in the queue registry, whatever you want to call it. Um, I'm waiting till 5 for that, and then I'll take a look at Navitus, which is like the tech company, after the call, after all the questions, all that stuff. I'll give my thoughts on the call and the guidance that we get. But so far I'm just going through the earnings report, kind of giving my opinion on the earnings report and the numbers I want to point out to you guys that I feel are pretty important to keep an eye on here. So another thing I want to point out is that the management for HIMS has raised their full year outlook, which adds to the bullish case by a lot. So let me go to guidance. I was looking at it. There we go. So here we go. For Q4, they're guiding revenue between 605 million and 625 million, with adjusted EBITDA between 55 and 65 million, roughly a 10% margin. And for the full year 2025, they expect 2.3 billion in revenue and 307 to 317 million in adjusted EBITDA, which is about 13% margin. That's called, what I like to say, sustainable, consistent growth, not just a beat and repeat quarter. It shows management has visibility into the business and confidence as we head into 2026. I think 2026 will really be the biggest year for this stock. And remember, this is all coming as they're expanding into new product lines, new product verticals. Not only this, we're also seeing international markets. We're really just at the start, as this is only really popularized, at least inside North America. And in my opinion, this stock is not just, it's not coasting. They're building something much bigger. Appreciate all your insight. Thank you, my friend Rob. Abbott was a great call 2 weeks ago, although they slipped. Of course, yeah, I mean, it's tough to say these days with the stock market. Sometimes stocks will have great earnings calls, and then the stock will drop, or there's other stuff in the macro economy. So I try to ignore the price as much as I can, really. I'm not trying to day trade. I'm not doing any of that right now. I'm not playing any options on this. I'm just saying, as a long-term investor, as someone who is holding shares in the company and plan to hold shares in the future, I think this is a good company to be in right now. That's all I kind of try to preach with this channel. It's companies that I think are good and that will continue to be good in the future. Analysts are raising HIM's short-term target to 75.90. Yeah, I agree with those price targets, and I think we'll see those flying in tomorrow morning. If not tomorrow morning, within a week, we'll see all the new price targets come in, because the analysts are always a little bit late. They down target it whenever there's one piece of bad news. They drop the target by like 50%, and then any new good news comes out, any good guidance comes out, and obviously they're gonna say, oh, the stock's gonna be up 50%. So I try to ignore the analysts too much. They're not too credible most times. But I try to do my own research here, give my own explanations on stuff. Did they give any explanation on 40% miss on earnings per share? I think let me check here. Earnings. Why can't I find it? EPS maybe. Struggling to find it. How exactly are after hours orders filled? I know there's like a pool. There's a market. I was talking to my buddy. He works at a Wall Street firm, and he says like they're kind of basically just trading these shares with each other. They're playing like football with each other, like trading these shares with each other. So I think let's break. I want to answer that question. Why did HIMS miss on earnings per share? From what I'm seeing here, the earnings per share, I can't find it, but I think the main reason why earnings per share was a miss, it doesn't point to a deterioration in fundamentals. I think it's mostly accounting factors, especially as they're offering a richer product mix and deliberate reinvestment. As we've seen, the cash flow is strong, adjusted profitability beat expectations, and management raised the full year guidance. So the headline earnings per share miss looks worse than it is. The story underneath, I think, is still very bullish, as we've seen the higher revenue, the stronger cash generation and the scalable model that could be pushed into other markets. I think another thing that might have diluted the shares was there was a higher share count from employee grants, and this caused the share count to rise year over year, as well as there were stock options and RSUs vesting. Even if total net income grows, um, even if total net income grows, a bigger denominator such as more shares can make the earnings per share look weaker. I think net income point number 3 has something. Net income. Let me check. Net income. Yeah. Oh, was 15.8 million for the third quarter, which included up 60.8 tax benefit related to the release of a tax valuation allowance, partially offset by tax expense. Yeah, I think this is probably the main thing that's causing this. I also think another thing was the gap earnings per share included several non-cash and one-time items that pulled the number down a lot. It's like these numbers are, you got to account for the stock-based compensation. You got to you got to account for depreciation and amortization as they continue to build out infrastructure. The tax effects, as we've seen in this point right here, I think the tax expense was one thing from higher cash balances and short-term investments. So I think it's not something to really worry about, especially as the revenue has grown, the margins are growing, the customer line is growing. I think it's something that we don't exactly have to look for. All the Someone pointed out all those numbers. I think those are all great numbers. Average revenue per user up. Yep, I was just pointing that out earlier. I think that is absolutely massive. It's not about how many users you can have. If we have 2 million users that are each growing and how much they are spending, that is still great. And obviously, this company will continue to grow into more markets. I mean, it's really, as far as I've seen, it's mostly only used in the U.S. So once it becomes an international brand, I think this stock will really explode in the next coming years, and I think it's a great company. They have a great product line. They're continuing to expand. They're investing in expanding in it, and I think that's crucial, especially at a company at this point where we're starting to see profitability. I think the big picture here is that HIMS is finally transitioning from a story stock into a real business, as we've seen. They've proven that telehealth subscriptions can scale. They've proven that customers stick around, as we've seen. The monthly online revenue per average subscriber is increasing. The amount of subscribers has also increased, and we've also seen that the profit margins improve as they scale, which is one of the main things I think you want to see with companies, especially when they're valued like this. It is one of the main things. If a company has high margins, the stock will really multiply tenfold from here. Also, as I was saying earlier, the average revenue per user alone shows that the platform's pricing power is very high, and they have a lot of customer loyalty. Combine all this with strong cash flow and healthy guidance, and you've got a company that's checking all the right boxes heading into 2026. If they keep executing, I think HIMS could eventually evolve into the Amazon kind of digital wellness, where a platform where there's multiple healthcare needs all handled under one roof with one common denominator. So that's all I'm kind of trying to get to. Like the numbers overall, FCF was flat year over year, maybe due to more spending. I was pointing that out earlier. I think the free cash flow has stayed just about steady due to the fact that they have kind of been focusing a lot on the product flow, and they're just starting to generate positive cash flow. So they're spending a lot on expanding product categories, and this is still, obviously, they're self-funding. They're not diluting. They're not creating debt for investors, which is another thing I think a lot of people aren't pointing out, and it's a reason why this has kind of remained flat. But their guide, if you looked at the guidance, I was looking at it earlier. Where is it? It was right here, I think. Where was it? Right here. Right here. The guidance, I think, is one of the main things, as they're guiding for revenue that is increasing and margins which are also increasing. So this is going to be continued sustainable growth, and It shows that management has a lot of visibility into the core business, and they have confidence heading into the next year. And remember, this is all coming as they expand the product line. Once they have more product lines, once they have the international markets, they will build into one of the biggest companies on the market, as we've seen. Oh, there we go. There's the call music. I can't even hear it because there you go. Oh, they got good music finally. I hate when they got like the medieval music. I know a lot of stocks have been having that music. I do not like that music personally at all. This is good music though. The stock's holding at 47. I think a lot will be answered on this earnings call, and that is why I will be taking notes myself, and then after the call, I will give you guys my thoughts. I'll give you guys kind of where I'm at with everything. But for now, I think I've kind of gone over all the numbers that I thought that were most important, and I think that the stock, we're still very early, unironically. I know everyone says that on Reddit, on stock twits, on Twitter, wherever you go. People say, "Oh, we're early. We're going to the moon." But I actually do think we might be going to the moon. Should have a 20 billion market cap at least. I agree. Let me check. What even is HIMS's market cap? I'm not too sure. I think it's lower. I know it's lower actually. Market cap 10 million. That's abysmal. 10 million market cap. That's unacceptable. That is absolutely unacceptable. And I am not enjoying a 10 billion market cap. So what would that imply? I mean, a 90 per share? That's not bad. I think that's possible by the end of the year. Net income likely due to increased manpower recruitment. Yes, I said that as well. The net income is likely due to that, and also the stock options that we've seen that a lot of companies have been using to keep their employees as well as grow employees. So I think it's not something to worry about at all. HIMS is kind of intentionally reinvesting a lot of its operating profit into expanding the telehealth infrastructure, marketing new product categories, and building AI-based patient matching tools. And I think this kind of market is very undervalued. It's hard to even put on like a balance sheet. As we're looking here on a balance sheet, it's hard to account for all the stuff they're doing behind the scenes to make this a sustainable and growing business. And I think that's one thing that people are going to understate in the near future, but in the long-term future, it is something that will cause the stock to really grow very quickly. 10 billion, yeah, I just looked it up. It's only at 10 billion, which in my personal opinion, is very low. I think 10 billion is very low, especially for a company generating nearly, what was it? They're generating 2 billion year for year. What will happen Wednesday when RXRX releases their earnings? I have no clue. I will have to look into it more as the time comes. I've kind of been focusing. It's tough with earnings season. We see all these different companies reporting earnings. Every stock has earnings, and every stock has different news going on. So it's all hectic. But focusing on HIMS right now. I think this is a great earnings from all the numbers I'm looking at, and there's a couple more things I want to point out. Let me just get this here. This music is pretty good though, I'm not even gonna lie. Gross margins fell too, again, I think due to added expenses like marketing, and I do think the gross margin is something to keep an eye on. I think the main reasons that they slipped was that, and it's completely fine at this stage of the growth, but I think it slipped because they're spending to scale new product lines, expand into the weight loss, mental health offerings, and they're investing in brand reach. I mean, I even before I was investing in like HIMS or even talking about it, I would see ads on YouTube. I would see ads all over the place. So I don't think it's something to worry about, the margin loss. And as they grow and they expand, the margin will only get better and better. That's one thing I think they should drive home with this call, is that once the company is expanding at a high rate, there will be really no stopping them in any regard. So I stuck at 148 for now. Is that how many shares you got, my friend? If that's how many shares you got, I mean, that's not bad. That's not bad at all. So yeah, I think the main things from this call, CEO of RXRX continues to unload a massive amount of shares. I don't think it's something to worry about for now, and it's not a large amount of shares. I think it was for taxes. I have been red for the last week. I'm hoping for 160 again. Oh man, I've been more. I think I've been more red than you. If you look at the ASTS chart, that's kind of my portfolio today. So if we're looking at this earnings, I think the massive thing is I'm stuck, have 3,000 shares. I mean, 3,000 shares is a good amount, my friend. The revenue came in at nearly 600 million, which is up nearly 50% year over year. That is one of the main key driving points that we're gonna have to keep an eye on here. And it's one of the things that is showing that this is a hyper growth for a company already approaching nearly 600 million per quarter. Almost all revenue came from online channels, and the core business is scaling perfectly. Worth jumping into the stock. Still some room to grow. No, I think this is like one of the perfect times to get into the stock, especially if you're holding for a longer term. I think we've seen this earnings in the last few like news reports, especially after, I mean, the stock's pulled back nearly 50%, and it's all despite we've seen strong, consistent growth. And at this size, it shows that HIMS isn't just a fad. It's becoming a dominant digital health platform. This is a little over 141k. Hey man, congratulations. Have 3,300 shares, average price 36.72. Room to grow. Yeah, I agree. There's a lot of room to grow here. I was pretty late to the party. I missed the first run up. I had been watching the stock for so long, and I was worried for a second, and then I missed the train. I missed the train to 70. I was like, oh whatever, I missed it. And then as I was watching it, the stock went down to the 40s, and I was like, what even is this? I thought I missed the boat. I researched it, and I was like, oh, this is the greatest stock, but I don't want to buy in at 70. But at $47 a share, like it is right now, let me check. Yeah, $47, $47.30. It is literally a must buy. You keep talking, you're pumping. Yeah, a little bit. I'm definitely bullish. You're giving me hope. Hey man, there's nothing to need hope on. What do you think? How much upside is there for this stock? I think 1 year prediction. I think I used to do DCF models a lot more, but just like off the top of my head, I would say $95 to $110 a share within a year. And then long term, I mean, the limits are the limits are really endless. As we've seen here, the limits are really endless. As if they expanded to different avenues of growth, different product lines, different international customers. RXRX received 30 million. I think we'll see more information on that with RXRX, my friend. I'll respond to your comments later. Can you touch on subscriber growth once 21% quarter? Of course I can. I can give you guys some insight on that. So we've seen the subscriber growth is one of the most massive things we've seen here. It hit 2.47 million, up from 2 million last year. The growth is steady, and it's showing high quality growth. The telehealth subscriptions are similar to similar reoccurring revenue, where it's predictable and scalable, and I think this is going to be very important. It's one of the most predictable markets, and it's a very good subscription base. Hell yeah, brother, 90s, I think so. 95 in a year is worth to jump in for sure. Hope you're right. I'd like to say I'm right. Of course, there could be a stock market crash. I do not believe there will be a. We hear about that stuff every day, though. If you're investing for the long term, you just got to ignore the people saying, oh, we're gonna have a recession, or this, that, the third, because they're usually just playing options. But another thing I want to point out is the average revenue per user, which it jumped from 67. Oh, right here. I keep missing it. It's just written very weirdly. Instead of average, it says monthly first. It jumped from 67 to 80. And that's a huge signal that customers are spending more across categories like hair loss, weight management, skincare, And this is one of the main things. We've also seen the profitability that is very strong this quarter. They're not burning cash anymore. Very profitable, free cash generating business, which is very rare for telehealth companies, and it's something that I think you got to keep an eye on, as well as the strong guidance. It shows that there's management confidence. By raising guidance after a big quarter like this, it shows that there's a lot of momentum behind the scenes, and there's a lot of stuff that we do not know about behind the scenes, and it's showing that they're doing something fundamentally right. Can you explain what they do differently than their competitors? I mean, they have the most wide range of products, I would say, compared to their competitors. I think they have the best interface compared to their competitors. I think they have the best advertising compared to. There's I could keep listing different stuff. I think the key drivers though are the more categories though. They've really expanded into almost everything. They have weight loss. They have dermatology. They have mental health. Not only this, they have the best retention out of any of these telehealth companies. They have the cross selling across the ecosystem of different products, and which is also leading to increasing brand awareness and leverage from different investments that they have made in like tech and logistics, which has made this company become a major digital health platform, in my opinion. And of course, as I was saying earlier, the earnings per share miss isn't a red flag because it was due to non-cash items like stock compensation, reinvestment, and the tax losses we've seen. So the biggest picture is that this is no longer speculative. This quarter shows that the business model really works, and it's starting to scale in a way that Wall Street can't really ignore, as we've seen in the past. So if you want, I'm liking it. Good stuff, brother. Thank you, my friend. I appreciate you guys for all being here. Yeah, earnings call should be any second now. Still listening to music on my end. Good reviews from customers. Yeah, everyone. I even know people personally that use it, and there's only good news. Not sure if you touched on this earlier, but they have planning a deal with NVO. Or again, not sure. I love that.
Thank you for standing by. My name is Eric, and I will be your conference operator today. At this time, I would like to welcome everyone to the HIMS and HERS third quarter 2025 earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 again. Thank you. I would now like to turn the call over to Bill Newby, Head of Investor Relations. Please go ahead.
Good afternoon, everyone, and welcome to the HIMS and HERS Health third quarter 2025 earnings call. Today, after the market closed, we released this quarter's shareholder letter, a copy of which you can find on our website at investors.hims.com. On the call with me today is Andrew Dudum, our co-founder and chief executive officer, and Yemi Okupe, our chief financial officer. Before I hand it over to Andrew, I need to remind you of legal safe harbor and cautionary declarations. Certain statements and projections of future results made in this presentation constitute forward-looking statements that are based on, among other things, our current market, competitors, and regulatory expectations, and are subject to risks and uncertainties that could cause actual results to vary materially. We take no obligation to update publicly any forward-looking statements after this call, whether as a result of new information, future events, changes in assumptions, or otherwise. The risks, uncertainties, and other factors that could cause actual results to differ from our forward-looking statements are described in our earnings release and SEC filings. Please see our recent earnings release and most recently filed 10-K and 10-Q reports for a discussion of these risk factors as they relate to forward-looking statements. In today's presentation, we also have certain non-GAAP financial measures. We refer you to the reconciliation tables to the most directly comparable GAAP financial measures contained in today's press release and shareholder letter. You can find this information as well as a link to today's webcast at investors.hims.com. After the call, this webcast will be archived on the website for 12 months. And with that, I will turn the call over to Andrew.
Thanks, Bill. The third quarter was another strong step forward for HIMS and HERS. Our strategy is working. We're expanding reach, deepening engagement, and transforming how people experience healthcare. And the most exciting part is that this growing scale is making the entire experience better for our subscribers. HIMS and HERS is one of the few healthcare platforms where each customer engagement improves the overall experience. Scale doesn't just make us bigger, it makes us better. The learnings from each encounter position us to drive better experiences, stronger customer relationships, and wider accessibility. Personalized care sits at the center of this evolution. Our growing scale means more people have access to treatment plans that can adapt to their unique needs, biology, and goals by incorporating a variety of form factors, dosing regimens, and multi-condition solutions. Our consistent focus on democratizing access to these types of experiences continues to deliver meaningful results for our business. At the end of the quarter, subscribers using personalized solutions grew 50% year over year, helping drive nearly 50% in year-over-year revenue growth. Over the past few years, how we serve our customers has evolved in extraordinary ways. We started by helping people access simple, effective treatments for a narrow set of conditions. Then we expanded into personalized, multi-condition care, giving customers a single place to manage a wide variety of health challenges with solutions tailored to them. Now, looking ahead, we plan to go beyond helping people treat their existing conditions and start helping them proactively manage their health before conditions even materialize. As we continue building a platform that unlocks broader access to care that's personal, proactive, and connected, we expect that broader collaboration will become key. Whether that's through partnerships, investments, or joint innovation, we see enormous potential to work alongside others across the healthcare ecosystem to make this future a reality. As we noted in our earnings release, we are in active discussions with Novo Nordisk to make Wegovy injections and, once FDA approved, Novo's oral Wegovy available through our platform to continue advancing consumer options. Earlier in the quarter, we announced a partnership with Marius Pharmaceuticals, which will allow our customers to access one of the few FDA-approved oral testosterone treatments in 2026. We expect these solutions, combined with consistent provider support and the ability to seamlessly track hormone levels via the HIMS app, can help redefine how millions of men access effective hormonal care. And most recently, we made a strategic investment in Grail, the company behind what we believe is the most advanced multi-cancer early detection test on the market. We are proud to invest in a company that shares our vision for the future. These relationships underscore the potential of what we've been building. They reflect our ongoing commitment to making our platform a powerful curator of the best-in-class health and wellness solutions. Over time, we plan to pursue a mix of strategic investments, partnerships, and collaborations in order to build a single destination where customers can access a range of innovative offerings alongside the most personal, convenient care available. These recent developments are an exciting glimpse into a future where access to proactive, preventative care is not a privilege, but a standard. I've never been more excited about where this company is heading. When we initially shared our 2030 goals earlier this year of more than $6.5 billion in revenue and $1.3 billion in adjusted EBITDA, it was with this clear vision in mind. Today, we're delivering against that vision in a real way. The opportunities to accelerate our trajectory are materializing quicker than anticipated, and we are leaning in. Let's start with weight loss, which remains one of the most important global health challenges impacting nearly 1 billion adults around the world. Since launching this specialty nearly 2 years ago, we've shown that combining reliable access to effective medication with a best-in-class experience has the potential to change lives. We believe that customers are best supported when they have access to data-driven provider recommendations, ongoing clinical guidance, and easy-to-use digital tools that track progress. The foundation behind our continued growth will be the ongoing verticalization of our compounding infrastructure. We believe investments in these facilities are establishing a new gold standard for compounding infrastructure broadly, positioning us to accelerate growth while maintaining the high standards of safety, quality, and affordability our customers are accustomed to. Importantly, this means all active pharmaceutical ingredients in compounded treatments are sourced from FDA-registered facilities. And in cases such as semaglutide, for which the FDA recently established a green list of GLP-1 API suppliers, we source solely from these suppliers. As our scale has grown, we've also shown a consistent track record of translating that growth into greater efficiency. This track record and ongoing efforts to verticalize our sterile compounding operations support our ongoing pursuit to make GLP-1 offerings increasingly accessible. Recently, we strategically reduced prices across compounded GLP-1 treatment plans by as much as 20%, extending accessible care to an even broader population. In the quarters ahead, we'll also continue expanding the breadth of options accessible through our platform. Our technology and vertically integrated infrastructure are unlocking new levels of personalization, most recently with the addition of microdosing options for compounded semaglutide treatments. It's allowing us to deliver what we believe is the most high-touch, patient-centric experience in the market. And as we help more customers find the right treatment and support providers in evolving patient care, we're continuing to strengthen that leadership position. Put simply, we're making it easier for more customers to start, stay on, and succeed in their own weight loss journey. And we're confident that we'll continue to drive results for a growing set of customers by doing so. We're also extending the benefits of our consumer-centric approach to new specialties. We believe recent launches supporting low testosterone and menopause unlock significant long-term growth opportunities and increase our ability to deepen relationships with existing subscribers while expanding access to care for millions more. The current state of hormone healthcare in the U.S. reflects the exact challenge HIMS and HERS was designed for. Conditions that impact millions, available treatment options that can make a real difference, and a system that still makes access far too hard. We're changing that. Millions of men experience symptoms of low testosterone, but face stigma, confusion, or limited access to effective care. Our recent launch aims to address these issues with access to personalized, provider-guided treatment plans supported by at-home lab testing. While still early, the response to this launch has already indicated an immediate product market fit, and we're actively optimizing both the experience and the operational engine behind this offering to meet the strong demand. Through our perimenopause and menopause offering, we're addressing one of the biggest gaps in women's health. Nearly 1.3 million women in the U.S. enter menopause each year, yet only 30% of OB/GYN residency programs offer formal training on how to treat it. Our new HERS offering helps close this gap by providing access to personalized care and support designed specifically for women during this stage of life. We expect this offering to become a meaningful growth driver as the HERS brand reaches more women and scales towards $1 billion in annual revenue in 2026. Together, these launches expand our reach across life stages and conditions, and more importantly, they lay the groundwork for the next era where HIMS and HERS can change the status quo for millions of customers, proactive health, and diagnostics. We plan to launch comprehensive, whole-body lab testing before year-end, which will represent a significant step forward in this evolution. By scaling capabilities like blood testing, we're thrilled to help more customers affordably access the insights they need to monitor, maintain, and improve their overall health. We envision these capabilities empowering consumers to proactively address health concerns such as vitamin deficiencies, unoptimized hormonal levels, and genetic risk factors, while also identifying early indicators of more serious conditions like cancer and cardiovascular disease. Historically, people have come to us to manage existing conditions. Soon, we'll help them take a more proactive role in managing their health, and in doing so, can potentially impact millions of lives. Our goal is to one day help identify and manage risks associated with heart disease, metabolic disorders, neurodegenerative diseases, and cancer, long before symptoms appear. We believe our platform is uniquely positioned to make this possible. We have the lab testing capabilities to give customers and providers deeper health insights. We have the provider network and compounding infrastructure in place to help take action against those insights. And we have a strengthening data feedback loop that can help measure, adapt, and refine care at scale. We believe that combination positions HIMS and HERS to do what few others in healthcare can: turn data into tailored action for millions of people. These capabilities, alongside our California-based peptide manufacturing facility, which is actively onshoring R&D for core peptide applications, form the foundation of the longevity specialty we plan to launch in 2026. We plan to scale the specialty to feature a broad range of therapies in addition to our new testing options. Over time, we expect these will include peptides, coenzymes, GLP and GIP treatments designed to improve performance, recovery, and cardiometabolic longevity markers. Each of these initiatives are part of a broader effort to make advanced diagnostics and the care that follows more accessible. Through investment and, when appropriate, partnerships, we expect this type of care, which has historically been accessible only to a small, affluent subset of the population, available to each of our customers. Finally, our success in the US and UK gives us real conviction that our model can scale globally. We believe that this team, vision, and balance sheet we have in place are uniquely positioned to scale a leading consumer health platform globally. In Europe, our acquisition of Zava Global gives us the infrastructure to serve customers across the UK, Germany, France, Ireland, and Spain. We're now reaching a total addressable market of more than 200 million adults across these regions, and the early response continues to validate how naturally our model translates. Next, we're preparing to launch in Canada in the near future, notably expanding our North America presence. With 2/3 of Canadian adults overweight or living with obesity, we're incredibly excited about this opportunity to make high-touch care more accessible. We are in active discussions with leading generic manufacturers to ensure that once semaglutide becomes available in generic form in 2026, we are ready to deliver access through our platform. Looking ahead, we see international markets as a powerful long-term growth opportunity representing more than $1 billion in potential annual revenue. We're deploying meaningful capital to bring the Hims & Hers experience to more customers across the UK and broader European markets, where we see a significant opportunity to scale our model and deepen our presence. We believe Hims & Hers will soon become the largest global consumer health platform, unlocking access to direct-to-consumer, personalized care for more customers than any company in the world. This approach extends across our entire business. The runway for growth and the opportunities to drive accelerating adoption across a wide range of conditions and health concerns are clear. We'll keep investing in what matters most, expanding our reach, deepening engagement, and broadening our capabilities, allowing customers to manage and improve their health on one single platform. Since founding this company, I've never been more excited than I am right now. The future of healthcare is ours to build, and we are building it piece by piece. With that, I'll pass it over to Yemi to talk through our financial performance and updated outlook for 2025.
Thanks, Andrew. I'll start by providing an overview of our third quarter financial results before going deeper into our final outlook for 2025. In the third quarter, our commitment to doing more for our customers drove another period of exceptional growth and expansion. By consistently introducing new, innovative offerings and broadening the range of specialties we support, we're systematically increasing the number of individuals we are able to reach and help. This growing breadth of care, anchored in a precision medicine-based approach, is enabling us to reach customers at multiple points throughout their healthcare journey and evolve with them as their needs change. During the third quarter, revenue grew 49% year over year to nearly $600 million, while adjusted EBITDA margins were above 13%. In the third quarter, our subscriber base increased sequentially by more than 30,000, reflecting a year-over-year growth rate of 20%. We see the formation of a robust foundation of multi-year growth levers across three key areas of our portfolio: offerings under our HIMS brand in the US, offerings under our HERS brand in the US, and an expanding portfolio of international markets. Within our HIMS brand, we are making a deliberate effort to transition away from generic on-demand sexual health solutions towards more personalized daily treatment offerings that allow providers to address a wider spectrum of needs. Excluding the impact of the current sexual health transition, subscribers in the third quarter grew north of 40% year over year. Our expectation is that the effects of this transition will meaningfully dissipate in the second half of next year. We believe that these dynamics, in conjunction with the launch of new offerings such as testosterone, will result in accelerating growth in the second half of 2026 within our HIMS portfolio. Switching to HERS, we've seen the collective offerings under our HERS brand grow near or above triple digits for the last several years and are now on pace to deliver revenue of over $1 billion in 2026. We expect the addition of new specialties such as menopause, diagnostics, and longevity to continue driving strong growth across the HERS portfolio. Before going deeper into the investments we are making to drive growth across our strategic areas, I'll provide an overview of profitability dynamics. During the third quarter, adjusted EBITDA grew more than 50% year over year to $78 million, offering another strong proof point of our team's ability to execute with discipline and deliver results consistent within our capital allocation framework. Adjusted EBITDA margins increased relative to the prior year, a significant leverage on our marketing spend, more than offset higher costs, and we continue to benefit from investments that are enabling us to scale new specialties, expand our global footprint, and further elevate the talent across the organization. In particular, we're making meaningful investments in talent across our technology organization as we build out the team and infrastructure that will power our next phase of expansion. Marketing as a percentage of revenue was 39%, representing more than 6 points of leverage year over year. We continue to see acquisition gains through lower cost and non-paid channels, benefits from higher retention as more subscribers benefit from personalized offerings, and a more stable backdrop within our weight loss offering. Each of these factors has resulted in leverage from revenue growth outpacing marketing and investment. Gross margins declined over 2 points quarter over quarter to 74%, as tailwinds from continued growth in non-weight specialties were offset by lower intra-quarter revenue recognized per shipment from certain weight loss offerings due to shorter shipping cadences. G&A costs were also pressured as a result of the Zava integration, as well as additional expenses related to the hiring of new leadership talent. G&A as a percentage of revenue increased 2 points year over year. A similar dynamic was seen in operations and support costs. Technology and development costs as a percentage of revenue increased nearly 2 points year over year to 7%, reflecting ongoing investment in engineering and product talent across the organization. We expect to continue investing in this area over the coming quarters as these initiatives enhance the customer experience and drive long-term financial returns. We believe these investments will pay back over the mid to long term in the form of reduced costs from greater efficiency, but more importantly, through unlocking new growth vectors for the company in the future. Our priorities center around long-term free cash flow generation, and each of the investments we are making today set the foundation for greater free cash flow generation in the future. In the third quarter, cash flow from operations was $149 million, which translated into free cash flow of $79 million. At quarter end, we had over $1.1 billion of cash, short-term, and long-term investments, of which $630 million was held in cash and short-term investments. The strength of our cash flow and balance sheet places us in a unique position to strategically deploy capital to expand both organically as well as through strategic M&A opportunities. We believe this to be a meaningful differentiator and opportunity to cement our leadership position, as we do not believe that there is a peer in our space that has the resources and expertise to do the same. Similar to prior quarters, we expect to invest across the following areas. First is continued verticalization and expansion of personalized capabilities within our facilities. In the coming quarters, we expect our operational footprint and capabilities to continue to expand. We entered the year with a facility footprint of just under 400,000 square feet and expect to leave the year with a footprint north of 1 million. This will enable us to unlock additional form factors like gummies across a broader set of specialties, increase capacity for fulfillment of sterile offerings, as well as leverage insights from diagnostic capabilities to have an even more comprehensive set of multi-condition offerings. While we expect to see retention and acquisition benefits across each of our specialties, this will be a particularly important component with respect to, one, broadening the appeal of our sexual health offering while we transition from on-demand offerings towards daily solutions, and two, leveraging verticalization to make higher complexity offerings inclusive of our weight loss and testosterone solutions more affordable with minimal long-term margin sacrifices. Second, we plan to continue expanding the breadth of solutions and enhancing the customer experience across our new specialties. In the third quarter, we were pleased to launch our low testosterone offering and have already seen strong interest from our current subscriber base. In the fourth quarter, we have launched solutions for perimenopause and menopause support and plan to launch comprehensive lab testing diagnostics, both of which we believe will be meaningful accelerants to the business. We expect continued investments in our facilities will enable us to broaden solutions within these specialties as well as reduce costs through verticalization. Third, we continue to see strategic investments, partnerships, and collaborations as powerful tools to extend our impact and advance our mission. Our recent investment in Grail exemplifies this approach. Through these initiatives, we see real opportunity to leverage our balance sheet to strengthen relationships across the broader healthcare ecosystem. Over time, these efforts can make new and innovative developments in healthcare more accessible to a broader portion of the population. Fourth, we expect to make meaningful investments in the capabilities of our technology platform. We believe the breadth of data on our platform and its utility value in helping our subscribers optimize their health will meaningfully increase with the launch of deeper diagnostic testing from our offerings. This can come in the form of data-driven treatment recommendations, chatbots to enable faster non-clinical customer solutions, or AI-assisted tools such as nutritional coaches. We are already seeing early wins and look forward to bringing deeper updates on this front in the future. Lastly, our mission to help the world feel great through the power of better health does not have borders. Success in the UK was a catalyst in our expansion into Germany, France, Ireland, and Spain through the Zava acquisition, and soon we will add Canada to that list. The strength of our balance sheet and the considerable cash flow profile we built in the US position us to deploy capital into these more nascent markets in a disciplined way. Additionally, we expect to meaningfully scale our operations in the UK with more investment in expanded capabilities and reinforcement of our brand, given signals around the significant opportunity that we see. Further refinement of our playbook unlocks our potential to expand in Brazil, Australia, and other Latin American and Asian markets in the future. Hims & Hers is undergoing another significant evolution on multiple fronts: technology, new capabilities, new specialties, as well as expanding geographical coverage. One of the most exciting shifts will come from what our upcoming launch of comprehensive whole-body diagnostic testing will bring. Currently, consumers come to our platform seeking a solution for a known condition that they want help with. With deeper diagnostics, we believe we'll be able to orient toward a model that allows subscribers to proactively manage their health in pursuit of healthier and longer lives. This will enable us to attract a broader set of consumers as well as deepen engagement with our current subscribers. Over the coming quarters, we expect to elevate investment to unlock capabilities to improve the experience we bring to current and future subscribers. Investment will be focused on accelerating adoption in new specialties, enhancing our technical talent to build a next-generation technology platform, and cementing our leadership position by delivering greater value to our subscribers. Our capital allocation framework will remain in place, and we believe, similar to past investment periods, we will realize a meaningful return on these investments in the future. With that, I'll double-click into our outlook for the remainder of the year. In the fourth quarter, we expect revenue to be between $605 to $625 million, representing a year-over-year growth rate of between 26% and 30%. We are anticipating adjusted EBITDA in the range of $55 to $65 million, reflecting a 10% margin at the midpoint. For the full year, we expect revenue to be between $2.335 and $2.355 billion, reflecting a year-over-year increase that ranges from 58% to 59%. We are anticipating adjusted EBITDA in the range of $307 to $317 million, reflecting a 13% margin at the midpoint. Behind our outlook are the following assumptions. First, we expect the migration fulfillment for sterile weight loss products to 503A facilities to drive between $20 to $25 million of headwinds in the fourth quarter from shorter shipment cadences that result in less revenue recognized per shipment. This dynamic will normalize in the second half of 2026 as the cohorts of customers refilling their orders accumulate. We are making meaningful investments to expand our internal 503A sterile fulfillment capacity. Progress on this front gave us conviction to make GLP-1s more accessible through lowering the price points for our 2-month, 4-month, and 6-month offerings in the fourth quarter. This is expected to come with near-term margin headwinds that will normalize in the second half of next year as we continue to progress with the verticalization of our sterile fulfillment capabilities. Second, we continue to expect at least $50 million of incremental revenue from Zava in the second half of the year. Since closing the acquisition in July, momentum has been strong, and we're actively deploying resources in our proven consumer-centric playbook to capture the significant market opportunities we see across Europe. Lastly, we expect the continued moderation in our on-demand sexual health business to persist in the near term, though these headwinds should begin to ease in 2026 as daily sexual health subscribers and multi-condition treatment plans become a larger share of the mix. The ongoing shift for personalized offerings remains a key driver of long-term revenue retention, supporting our target of 85% or higher, positioning the business for more durable, recurring growth over time. As Andrew mentioned, we're excited to be in a position where we can confidently invest in the long-term trajectory of our business. We expect these investments to start in the fourth quarter and continue through 2026 as we scale new categories, build a larger presence in new markets, and begin driving greater value to subscribers through innovative partnerships. While this may result in a temporary pause in year-over-year margin expansion, we believe these investments will meaningfully extend the reach of our platform around the world. With the immense opportunity in front of us, our conviction remains high in our ability to meet or exceed the 2030 targets we established earlier this year. at least $6.5 billion in revenue, and $1.3 billion in adjusted EBITDA. Our success would not be possible without the significant efforts of Hims and Hers employees around the world. I'd like to thank them, our subscribers, and our shareholders for supporting us in our mission to help the world feel great through the power of better health. With that, I'll turn it back to Bill to kick off Q&A with 2 questions from our retail investor community.
They haven't added anything to the earnings really from this call so far.
Thanks, Yemi, and thank you to all the investors who sent in questions over the weekend. We received a number of questions on the upcoming launches of lab testing in our longevity offering. This one comes from Nick G. What is the timeline to release a full stack subscription service that includes at-home testing and additional products and services like peptides and a broader longevity offering? What are the biggest hurdles to this type of rollout?
Yeah, thanks, Nick, for that question. Great question. We are extremely excited about both of those 2 categories. As we shared in the prepared remarks, we will be launching the whole body lab testing on the platform very soon before the year end. I think this is a really exciting one for me personally. I mean, this is a set of tests that historically cost me and my family, upwards of anywhere from $5,000 to $10,000 for this type of comprehensive testing, and we'll be bringing it to market for an absolute fraction of that cost. So really an incredibly powerful opportunity for true equalization for anybody out there to be able to get a sense of where their body's at, where their family is standing, and the people that they love, making sure that they're getting ahead of any issues that they're unaware of. I think this testing lays the foundation for the longevity specialty that we mentioned, which again is a really exciting new category. This specialty will be coming to market in 2026 and will include a really wide range of treatments from on-market peptides, coenzymes, GLP, GIP treatments. All of that will be designed and blended with performance, recovery, cardiometabolic, longevity markers as the core optimization of choice. So this is a category that is, again, leading the charge on health and wellness. It's something that a very few have access to today. And I think the great equalization and bringing this to more people is going to be something that's going to be incredibly powerful. In that category, we're also hopeful that the current administration can help further expand access to more of these peptides. I think there's a growing list of them from BPC 157 and TB 500 and others where research is starting to show real health and longevity benefits. And I think expanded care there is just going to be great for customers. I think the other advantage we have in this category, which is an exciting one, is as you all remember, we acquired the California-based peptide manufacturing plant, and that facility is up and running and operating, and currently onshoring a lot of R&D that I think is going to be very important for the vast range of options on the peptide side that will be a part of this future category.
Thanks, Andrew. The next question comes from the HIMS House community and focuses on some of the trends we're seeing in our longer tenured businesses. The question is, earlier this year, you indicated the core business was meeting or exceeding expectations. It's now clear that we've started to see some growth deceleration in a few of these places. How confident are you that you'll be able to re-accelerate core growth over the coming quarters, and what specific levers can you pull, and what's the realistic timeline to see these results?
Yeah, thanks for the question, HIMS House. I think what we see is we see the world rapidly evolving with new specialties, and we see the specialties more and more becoming a blend of one another. I think as we look at some of the new capabilities that we'll have later this year, such as diagnostics, I think that's only going to further accelerate. And so we increasingly see each of the components that we outlined and Andrew laid out and the vision for where the company is going to in the future as really becoming part of the core offering. And so we spoke around this a little bit in the prepared remarks, but we increasingly look at the business across a few strategic areas. The first is HIMS US. The next is then our HERS US business. And finally, we see a great deal of opportunity in the international markets. As we look around, just the scale and the footprint of opportunities within each of those strategic areas, we see several growth factors that have the ability to not only continue to drive strong growth, but potentially accelerate it in the second half. So these could be new specialties, such as testosterone in the HIMS brand, or menopause and longevity in the HERS brand. And so as we also start to shift towards being able to proactively help consumers manage their care with lab diagnostics, I think these trends are only going to accelerate. We spoke about some of the near-term headwinds that we're seeing this year with respect to the shift towards the daily sexual health consumers and away from the on-demand sexual health users, as well as some of the dynamics around the shorter weight loss cadences. As we start to turn the corner around those in the second half of the year, we remain very confident that we'll see both the Hims and Hers businesses not only remain strong growth drivers, but also potentially accelerate growth in the future.
Thanks, Yemi, and thanks again to everyone who sent in questions. With that, I will pass it back to the operator to begin the regular way analyst
This is a good
Q&A.
earnings so far. It's just pretty boring. There hasn't been
Thank you.
materially. But
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We ask that participants please limit themselves to one question and one follow-up question. Your first question comes from the line of Justin Patterson with KeyBanc Capital Markets. Please go ahead.
Great. Thank you and good afternoon. Andrew, as diagnostic capabilities ramp up, how do you envision the pace in which you provide personalized treatments and expand into new specialties changes? And then related to that, how might you adjust your marketing efforts to make more consumers aware of just this expanded offering? Thank you.
Yeah, great question, Justin. I think it's going to rapidly accelerate the pace of bringing new products to market. When you can understand everything from nutrient deficiencies to kind of genetic risk markers, your ability to adapt the assortment and SKU and hyper-personalize just accelerates. And so, we shared in prepared remarks that, by year end, we'll be, north of 1 million square feet of infrastructure and have really built what I think is gold standard in, true high quality compounding capabilities. My hope is that the diagnostics open up a real floodgate of opportunity for hyper-personalization. On the marketing side, I think it's a really big change, which is a really exciting one. I think historically the business has been, very much direct marketing focused, given the very stigmatized conditions that we offer, right? Things like hair loss, sexual health, et cetera. When you start getting into diagnostics, when you start getting into longevity, whole body health, wellness, these are categories that you want to talk about. They're categories that you want to share with the people you love, right? They're categories you want to share with your family. There are products within this offering that I personally have been, buying for my family for years because I just want my loved ones to have access to them. So I do think there's going to be a really structural change in how you see the Hims and Hers brand show up, the types of messaging that is going to be going out there. I think this ultimately allows for, great long-term leverage in the business, which is really exciting, but also just can really transform how people know our business to be, right? Instead of coming just for acute issues, I think there's an opportunity here to build a platform globally where, not only tens of millions, but hundreds of millions of people can rely on you to help get ahead of health and help get proactive with health. And I think you're really gonna see that show up in the transformation of the brand and the types of messaging and the types of places that we're showing up.
Great. Thank you.
The next question comes from the line of Maria Ripps with Canaccord Genuity. Please go ahead.
Great. Thanks so much for taking my question. I just wanted to ask about sort of your approach to the portfolio of GLP-1 solutions on the platform, especially if the Novo partnership moves forward. And I guess, are there any other GLP-1 solutions that you may add to the specialty? And then secondly, can you maybe talk about sort of consumer price sensitivity to compounded GLP-1s at this point? And how do you see sort of price reductions impacting demand? Thank you so much.
Yeah, thanks, Maria. Great question. I'll talk to the first part and maybe jump on the second. Generally, I think breadth and assortment and choice for patients is the winning formula. So we're excited to be able to, re-engage with Novo about the Wegovy pill that is hopefully to be FDA approved, as well as the commercial dosing. I think they and others will have more and more innovation coming There's also obviously advancements in biotech that are in phase 2 and phase 3 trials that have next generation GLP-1, GIP, dual and triagonist opportunities. So, our stance is that breadth and assortment and choice ultimately gives each individual, more personalized abilities to just have great outcomes. And so you'll see us continue to pursue a wide range of treatments here. I think generally it's inevitable that, partnerships like this, where we are, the largest consumer distribution platform in healthcare, and others are, the best in bringing, new therapeutic innovations to market. Those types of companies should be working together ultimately. So I think you're going to see more of that in the ecosystem, but it's definitely something that we have, a lot of brain power on, and are making sure that as advancements in the next generation comes, we have great relationships with the teams, and they understand the opportunities that we can have together.
Yeah, and then to hit the second part of your question, Maria, I think our weight loss specialty follows a very similar principle that we've deployed across our historical specialties. And that centers around, scaling, verticalizing, and optimizing, and passing the value and the savings, back to our subscribers. And so we do see, across both our weight loss specialty, inclusive of the orals as well as GLP-1s, is the high touch model that we have with providers really is resonating with, our subscribers. We see strong retention across the platform. Our view is that as we, similar to other specialties that we've done within the past, as we're able to, make the price points more accessible to a broader base of users, that will enable us to continue to draw on a broader audience. And so we see some very early promising signs with some of the recent changes, that we've made. We're excited to continue to invest to verticalize our operations at a high quality standard to continue to pass those benefits back to our subscribers.
Great. Thanks so much for the call.
From the line of Craig Hettenbach with Morgan Stanley. Please go ahead.
Yes, thank you. First question is just on the HERS business and the color of kind of approaching $1 billion in revenue in 2026. Can you just touch on just the cadence of the new menopause products, like how much that may move the needle, or do you expect kind of the growth to be driven mainly by the existing products going into 2026?
Yeah, I can speak a little bit to that, Craig, and Yemi, feel free to jump in. I think HERS has a really nice range of growth drivers. We've talked about in the last couple of quarters that growth rate being triple digits or around there, and I think there's real path over the next few years for it to maintain that type of trajectory. You've got legacy categories, quote unquote legacy, that are a few years old on the dermatology side that are still growing extremely quickly. You've got obviously the oral weight business, the personalized weight business on the GLP side that is growing very robustly. And then I think these new categories in hormonal health, perimenopause, as well as longevity and diagnostics are going to be, very, very important for women and this demographic. So it's a business line that I think has, 4 or 5 different growth engines. It's, probably one of the more exciting parts for me of the business, just because you're able to see the platform extend to completely new audiences, different ages, different demographics, and completely new therapeutic categories. But it's one where there's real diversity coming from the composition of that growth.
Yeah, I think just to add, a couple of things to that, Craig, I think what we also just see, as the HERS platform, has scaled, our ability to invest in the brands distinctly, continues to increasingly elevate. And so now with the broader set of portfolio that we have across things like mental health, the menopausal support, hair, weight, soon to be diagnostics, I think similar to what we saw with HIMS, that just gives us a broader spectrum with which to speak to our consumer base and capture them early in their journey. We also see, that, as Andrew mentioned, diagnostics as being a key evolution point, for the company that will benefit both the HIMS business and HERS business. I think that will enable us to proactively help consumers manage their care. And so while we're very excited by that business on a standalone basis, its ability to also, highlight newer specialties that we should be entering or personalize the treatments in a more precise fashion, I think will not only increase retention, but also broaden the subscriber base that we're able to reach, not only within the HERS business, but also the HIMS business as well.
Great. And then just as my follow-up, Yemi, appreciate the color on the investments you're making in the business. You kind of alluded to a temporary pause in margins. Is it possible margins could contract year over year in 2026 before you see the follow-through, or do you think, despite these investments, you can kind of hold ground on margins into next year?
Yeah, I think it's a bit too early to give specific color around 2026. The teams are actively undergoing the plans. I think we're following a similar investment thesis to what we deployed in the past, similar to 2023, where we lean into investment. Within a couple of quarters, we started to see rapid margin expansion. I think here we have a much broader set of levers, and I think what also just gives us the conviction in these investments that they will be accretive is some of them will be new capabilities and new specialties. I think we have a broad set of options to verticalize and optimize the unit economics on some of those new specialties. That gives a great deal of confidence. I think we're also investing in things like talent that tend to have a exponential and asymmetric ROI as those folks come in and start to really just change the capabilities and the trajectory for what our technology platform can do. We see a significant amount of upside. And so I think it's a little bit too early to give specifics around 2026 guide, but we do see an immense opportunity, not just for future growth levers, but for continued free cash flow generation, as well as in the midterm extensive margin expansion that we've seen in prior quarters as well.
Thank you.
Your next question comes from the line of Brian Tanquilut with Jefferies. Please go ahead.
Hey, good afternoon, guys, and congrats on the quarter. Maybe just on the topic of cash flows. I mean, buybacks were kind of strong in the quarter. Just curious how you're thinking about capital deployed towards buybacks versus obviously you're spending a good amount of capital on CapEx.
Yeah, I think we have the luxury of very strong free operating cash flow, as well as a very strong cash position. I think similar to prior quarters, anytime where we view that there is a meaningful disconnect in the valuation of the company, the market value relative to its intrinsic value, we will step in and act. And so I think in the prior quarter, we did see those dynamics take play with some of the volatility that we saw in our stock. So we opted to lean in. That said, I think that the first and foremost priority will always be around investing in the appropriate levers to grow the business. That includes, like we spoke around earlier in the prepared remarks, extending the set of personalized capabilities that we have to offer our patients, investing in the overall platform, as well as in international markets. But I think we just have the luxury of a very strong balance sheet and very strong cash flow, where we're able to do all of those things while at the same time realize disconnects between the intrinsic value and the market value when those arise.
Got it. And then I guess my follow-up, as I think about, obviously in the press release, you talked about the negotiations with Novo. As we think about your decision to bring down price on your GLPs and those conversations, I'm just curious, what are the negotiating points? What are the discussion topics that are kind of holding that agreement back right now, or what will it take to get it over the line? And then maybe just thinking about what the pros and cons are for rolling out a Novo product here, both for you and maybe for Novo. Thanks.
Thanks, Brian. I can probably answer that and, for better or worse, not give you too much information. But there's probably not much we can share on the specific conversations that have been going with Novo. I think we're excited to be engaging with them, and I think Mike is a great new leader for the organization. Generally, like I've said, we believe and have always said breadth of options for patients is best. We're a platform where we hope to give people the absolute right course of treatment, the right course of care, and connect them with providers that can help them make those decisions. And so from our perspective, we are constantly engaging with great innovative therapeutics, great innovative diagnostic companies, et cetera, next-gen biotech companies, because we just want to make sure that Hims & Hers truly does represent the must-have in healthcare over time. And ultimately, our job is to fight on behalf of everyday people to hopefully bring that to them at a price that is truly affordable to them and their family.
Your next question comes from the line of Eric Percher with Nephron Research. Please go ahead.
Thank you. I'd like to check in on weight loss growth components versus your initial expectations for the year. Ask if you're still on path for $725 million for the year or better, and a little bit of context on how the compound versus oral market has developed.
Thanks for the question, Eric. Yeah, I think the short answer is we see continued strength across each component of the weight loss specialty. The oral business continues to remain robust and grow at healthy rates. A lot of that is driven by the fact that there's broader eligibility requirements for our oral offering, as well as there's the ability to reach a broader audience of people that may be apprehensive around injectables. They're also at a price point where users are able to access them at a lower price, but still realize over half of the benefits that they're able to see on the injectable side. We also continue to see the GLP-1 offering remain strong as well, and so we are on pace to achieve the $725 million or greater target that we put forth earlier this year.
And on the personalized compounded side, you provided us with $20 to $25 million headwind. Was that? Did I catch that as 4Q? And could you just kind of speak to the cadence as you offboarded the commercial doses into 2Q to 3Q to 4Q? Help us a little bit there.
Yeah, so I think a lot of the drop that you saw earlier this year between the first quarter and the second quarter, that was primarily the result of offboarding the commercially available dosages that subscribers were on. I think as we look, to what's going to transpire over the next couple of quarters, what's effectively occurred is we started to ship the GLP-1s in smaller shipments. The net effect of that is we recognize our revenue on when shipments occur, not necessarily when the consumers place their orders. So we continue to see very strong order velocity, but because we're shipping in smaller cadences, that's effectively what's driving the headwind in the back half of this year that you see that we expect will materialize in the $20 to $25 million headwind. Now, what happens is as those consumers renew, because they're on a smaller or shorter cadence, as they renew more frequently throughout the year. And so what happens is you see a stacking of cohorts that kind of compounds each quarter. So our expectation is by the time we get to the back half of next year, this dynamic will largely normalize. And so it's less around internal dynamics around the business, and it's more around just like the adjustments to the shipping profile, cadence profile that we have for our subscribers.
Your next question comes from the line of Ryan McDonald with Needham. Please go ahead.
Great. Thanks for taking my questions. Andrew, I wanted to start on international dynamics. You've got Zaba obviously under your belt now for about a quarter. I'm just curious, as you've gotten more comfortable and familiar with that business and started to spend more time in international markets, of how much is the sort of the HIMS messaging and approach resonating outside of the U.S. market, and how's that informing sort of this international expansion plan? And as you think about these markets, it sounds like there's some pretty aggressive expansion. I feel like there's some a unique aspect within each country that sort of changes the dynamics of how care is provided. How do you, and what investments do you need to make to sort of scale your network of clinicians as you continue to broaden your reach internationally? Thanks.
Yeah, thanks, Ryan. It's a great question. Yeah, I think Zaba has been a wonderful first bite into the international space. Immediately a creative acquisition, just great team, great operational capabilities, and incredible learnings. They've already moved through quite a few markets already, which is been really fun to watch. I think probably the best takeaway so far is that we think the demand is the same as here in the U.S. Whether it's a national system, insurance-based system, it kind of doesn't matter. I mean, I think the global frustration with access to great healthcare is consistent wherever you live. The time it takes to meet with specialists, the quality of the care, the high-touch nature of the care, the personalized aspects of that care, the cost of that care, I mean, it's really, really quite consistent. And so we are, I think, given that, as well as given, I think, our confidence in what we believe is a really scalable operating model here in the US. Like, I think we've, over the last 8 years, optimized what we think is the winning formula, the winning experience for customers. I think we are now accelerating our ability to bring that into very key markets. And so as we shared, Canada will be going live in the near future. We're already in great conversations with all the major generic manufacturers up there in anticipation of the generic semaglutide, which goes live in 2026. We believe the Brazilian market is a really interesting market where we'll be spending time further deepening investments in the UK likely, as well as other smaller markets in Australia and Japan, et cetera. So, generally, I think we have a really good grasp of the competitive landscape in these markets, the consumer distinctions, the local dynamics to be aware of, the regulatory differences to be aware of. And so the experience might be slightly different in each. To your point, there might be nuances in positioning or in marketing or in offering. But generally, I think the frustration with care and the demand for a higher touch, consumer-centric care is very much widespread. And I think we have the team and the ambition and maybe the crazy, just a little bit of craziness in us, right, to go and attack this and be the winner quite quickly across all of these major markets.
Helpful call there. Really appreciate it. Maybe from a follow-up perspective, I wanted to ask on sort of whole body lab testing and how that might be structured or packaged or integrated within some of the other offerings like menopausal health, low T, longevity into next year. Unless we're mistaken, I think that what we've seen in our experience on sort of the whole body testing market, especially in a efficient manner for the consumer, is it can tend to be a little bit lower margin business from a gross margin perspective. So is that what you're seeing, or is that a risk from launching a standalone whole body lab testing offering? Or if so, how are you going to package it with maybe more longitudinal offerings on the HIMS platform to sort of enable that sort of, let's call it, strong LTV to CAC as we think about over the next year or two? Thanks.
Yeah, it's a great question, Ryan. I think I think we're a really unique company in our ability to bring at-home lab testing or lab testing to the masses because our business is in helping people be healthier, right? So we do not long-term need to make huge margin off of these tests, which is distinctly different from everybody in market. It's distinctly different from major lab testing companies, other competitors that have diagnostics. Our business is ultimately helping you feel great and helping you get ahead and helping you refine what that personalized care should be and then acting on it. And so I think, to your point, there will over time probably be a really nice mix of both standalone diagnostic opportunities, which then lead gen into advanced treatment care, as well as bundled services for diagnostics in core treatment pathways, like you've seen with testosterone. I think you'll see that kind of continue to expand. So I think there'll be a nice diversity there, but ultimately my ambition, as we have done in the past, is to bring these offerings to market, verticalize the infrastructure over time, which we've already started to do with our Tribe acquisition and other investments when it comes to lab diagnostics. Establish that, systematize that, bring the cost down to incredible levels where you can really and truly undermine most of the peers on price and give customers huge access to this information, and then ultimately be the trusted partner that can help them take that information and be incredibly action oriented and precise with what the next step should be, how the personalized care should follow, and the hand holding through that cadence. So I think we're really uniquely positioned to do exactly what you're talking about, but I think there's a true distinction with us, given the fact that our core business is to help keep you healthy and keep you on top of these issues. And also we have the ability to verticalize this infrastructure in a way that can leverage testing as lead gen into the platform.
Appreciate the color there. Thanks, Andrew.
The next question comes from the line of Jonah Kim with TD Cowen. Please go ahead.
Thank you for taking my question. You've seen nice leverage on the marketing side. Just curious if there has been any changes in your marketing strategy or approach. And as you think about the new year, how are you thinking about the marketing, especially around, Super Bowl and just lapping your great success last year? Thank you.
Yeah, thanks for the question, Jonah. I think we see, a couple different levers that we're able to deliver very strong marketing leverage, both on the quarter as well across the year. One is we do see, that there is significant leverage coming from the fact that we see more and more acquisition coming from both organic channels as well as via lower cost channels. I think as we start to push further into the comprehensive whole body testing that we spoke around earlier, that dynamic is likely to continue to get better and better as we kind of optimize and tune that engine. We also see from the shift of more and more users opting for personalized solutions, the retention is becoming stronger and stronger. And most of the marketing spend that we have is either around educating consumers around the overall brand or acquiring new users. And so as we see retention elevate, we inherently get leverage on that front. Now, what we do see is we have a wide array of different growth opportunities in front of us, and that will be coming in front of us in the coming quarters. That is some of the newer specialties that we've launched, such as testosterone, menopausal support, elevating our presence in some of the markets where we've already seen success, like the UK, as well as some of the markets that we will likely enter, or that we are going to enter in the near future, such as Canada. And so I think we're not going to be shy around investing. That said, I think we're going to do so in a way that's consistent with our historical capital allocation framework that calls for the payback period of 1 year, that basically positions the ecosystem to benefit from greater and greater economies of scale, so that as we look a couple quarters down the road from those investments, you start to see some of the leverage that we're enjoying right now from some of the investments we've made in the past. And so I would say as we look to 2026, as mentioned, the growth opportunity is probably even larger than what we anticipated before, so we will lean in and invest in that. That said, I think that the profile and our confidence in the ability to hit the 2030 targets of the $6.5 billion of revenue and $1.3 billion of EBITDA, is only increasing.
Got it. Thank you.
Ladies and gentlemen, this concludes today's call. Thank you all for joining, and you may now disconnect.
All right, my friends. That was a pretty solid call, if I do not say so myself. Not the most interesting, obviously, but I think it was, either way, a strong quarter, and it's something that I do want. I'll give you guys some of my insights, some of the notes I was taking here on the side. Of course, I'll recap that the... Wait, oh, what's going on? Lagging a little bit. Lagging, my bad. Let me close some tabs here. Alright, that should be better. Alright, so as we've seen, Q4, I think management has guided revenue between $2.35 billion to $2.55 adjusted EBITDA. This is a very healthy, about 50% margin. And I think that's not just keeping the pace. That's management saying that we know what's working and we're doubling down on it. I've noticed something about great companies. They don't just post the numbers. They project this conviction. They have belief inside the product. They use the product, and this is the main thing I'm seeing with HIMS and their operation, everything that they're running. That's how you build something that's enduring and something that will continue to grow in the future. I think what's really fueling this stock and what we'll see in the future. Of course, we saw the stock; it didn't really move too much today, but I think it's become something where the growth, it feels sustainable and not speculative, which is what it used to be when I first kind of found out about this stock. Yeah, I got to test and break. Exactly, we got to test and break 50. The number one things that stand out for me is the brand trust. HIMS has built something rare in healthcare, and it's a brand that feels approachable and non-judgmental kind of. It's kind of like a private company that they've made conversations about sensitive topics like hair loss, therapy, and they make it all seem normal. And that emotional connection is the main moat that this company holds. Also, they have the category expansion. As they move into weight loss, mental health, and skincare, this all isn't random. It's all synergetic, and it's all different avenues that will work with each other. These verticals reinforce the others. They deepen the customer's relationship with the brand, and this is also putting it all into another thing, which I want to point out. Number 3 in my list is the convenience. The process from your online visit to doorstep delivery, it just works, especially in this type of modern age we're in. We're in a world where most healthcare experiences are very frustrating. And if you ever go to the doctors, I know I try to avoid it, but whenever I go to the doctors, it is just a hassle. And this new system, it's going to keep stuff seamlessly, and it keeps people loyal to it. These 3 things, I think, are the main things that will make this company feel like the Amazon of personal health, more rather than just a one product telehealth app. It's really something bigger. It's basically the Amazon of health. That's how I see it, as a bigger picture. HIMS feels very different. It's a team that actually understands what long-term value looks like. They're not trying to dominate healthcare overnight. They're slowly owning one layer of it at a time, with an obsession for brand consistency and user experience. I've seen countless growth over promises and under deliver. They burn through cash, chase headlines and partnerships, and treat profitability like it's just in the back door. I think that this is the complete opposite with HIMS, and I think that's why we're seeing the slow, controlled expansion. It's how generational companies are really built in the future. I'm losing leg hair. I need some leg hair shampoo. See, there you go. Now you got to go on HIMS for that. I think this quarter is a clear turning point. This is when HIMS stops becoming a growth stock and it starts becoming a real business. They've proven the model. They're generating lots of cash. They're expanding with precision. They're expanding into these different markets. I heard them mention the UK, which is one of the key ones, I think. Once you really get Europe down pat, I think it will grow very quickly. And when I look at the next few years, I see HIMS now less as a telehealth provider and more as like how would I explain it? Like a consumer health platform. Like it's a one-stop shop brand where you could literally handle all of your medical needs from your phone. And I mean, it doesn't get much better than that. And I think that's really the future. That's the future we're building toward. And this quarter showed that we're actually getting there. The price didn't move much after the earnings, but where we are today, as we sit at this $46 mark, we're in the price zone of the 44 to 46. At the 50-day, the moving average is right around here. And I think a decisive move above or below the move, then we'll see what will really happen. I think if we go below, we might get a dip down into the 40s. But if we go above, then I think this will really, we have a lot of short-term momentum and midterm MAs, which are still above price, which leads to supply overhead. And most MA dashboards screen this as neutral to negative until price flips the 50-day. So once we see this flip the 50-day, I think this will really lead to us hitting 60 by the end of the year. But I think that I wrote down some lists. I think the main things that will lead us to 60 by the end of the year is regaining trend control. So if we close back above this 200-day moving average at 46.4 and hold it for 2 to 3 sessions with good volume, with above average volume, I think then we will start to move higher and we will break the lid kind of in a decisive close above 51. We'll turn the tape from kind of repairing into advancing, and I think this aligns with the fib I was looking at earlier. So we can expect a reaction kind of here at that level, at that $51 mark, which is where the moving average is at right now. And once we break that, I think 55 to 57 is a likely congestion area where we will have some prior trading shelf, and we have the post sell-off of supply. But I think the strong days are even any catalyst should push this into 58 to 59 once it breaks through 55. So, oh, sorry. Once it breaks through that, $60 is really just a psychological figure, and it looks for. And if we look for wiki intraday spikes and potential like fades on first touch, ideally you want to close above 58 first, then a follow through to print above 60. So that is kind of where we're sitting at now. I think the near dated catalysts are really going to be the earnings and the updated outlook flow. If the options market is implying 15% for the week and 21% for the month, so the range expansion is on the table. The main thing I want to watch out for is the recent FDA warning letter around compounded GLP-1s, but they have hinted at it being approved, and I think that would really confirm this run. And if we see two closes above 51 with accumulation volume, which is right about that 1.1 to 1.3, stop worrying. I know I like to talk about the price though. It's something we're looking at. It's we wouldn't invest in stocks if there wasn't numbers behind it. You know what I mean? So obviously if you're long term, just buy the stock and buy as much as you can. But I want to talk about the intraday because I get excited talking about prices on numbers on the screen. So what the bulls really don't want to see is a close below 42. If we lose the 200-day zone and prior swing supports, or we see a failed breakout that gets rejected at 51 to 52 on a lot of volume, then I think we might lose $40 on a closing basis. That typically will reset the setup back towards the mid 30s, but it shouldn't really happen, I don't think. If we get any catalyst here, we will really see this stock really start to take off. So my entry ideas are just getting in right now, just create targets at the 52 mark and watch it into 55 to 57, and if there's strength, if there's volume, scale into 60 and create a stop at the 42 or a tighter stop at 44 if you're entering late, and depending on when you're going to enter. But I'd respect that there's going to be the 20% implied monthly move and size, so a 10% adverse move doesn't dent the account. So in my opinion, is $60 by end of year plausible? Yes, but it does require the 200-day being reclaimed and a 50-day breakout with volume, which would lead a clean travel through 55 to 57. The path of least resistance flips all higher once the stock lives above 51 to 52. So until then, we're waiting for really a news. We're waiting for something major to come through. This earnings was really good in my opinion. I could really go over the numbers all day because this was one of the best earnings we've had so far for the company, and I think it really stands out. The company reported solid numbers, and this really just changed the way you see the business. Is 42 the 200? I'm pretty sure the $200, not the $200, 200, the 200-day moving average is 46.4. So it's right where we're at kind of right now. And then the 50 is at 51. Sell me some for that price. Never, I'll die with these shares. Okay, so you guys win. Yeah, I'll stream Q4, of course. I'm glad you guys stuck around with me, watched the earnings. I hope anything was insightful. I hope I'll go over kind of this earnings real quick one more time, just for anyone who joined late or is still kind of interested in the main points I have. The main points are really revenue up 50% year over year, and at 600 million for the quarter, that number is impressive on its own. But what makes it even more meaningful is where it's coming from, and it's coming from not one-off promotions, not one-off acquisitions. It's organic, reoccurring growth from a digital health platform that is continuing to grow, and it's finding its rhythm. HIMS' entire business model of online consultations, fast prescriptions, discreet packaging, direct delivery is kind of hitting the sweet spot where we're at right now between convenience and credibility. People trust it, they like using it, and more importantly, they keep coming back, and that is what we would see. I would be happy with 51 actually. Yeah, if we close above 51 for more than 2 to 3 days, I think it will just go to 60 really quickly based on the chart. But obviously, if that's only if you believe in technical analysis. I needed to hear it again because my short-term memory sucks. Hey man, I hear you, brother. Um, they also now have 2.47 million subscribers. This is up 21% from last year. That's very steady, healthy expansion, and its average revenue per user really tells the story here as it went from 67 to 80, nearly a 20% increase. That means customers aren't sticking around, they're deepening their relationship with the platform. They're adding new products into their portfolio. They're adding supplements, not because HIMS is pushing them to do it, but because they trust the experience enough to let it handle more of their health. And this is an important connection that I want to bring home to you guys. If you're watching this behind a screen like I am, the main thing is you're building a connection with these people. Every single one of these users, they're increasing the amount they're spending. They're increasing everything. We're growing at rapid rates, and the margins are very good for a company like this. TA is good for entries and stuff, but Trump can send a stop. Oh, of course, yeah. I mean, this yeah. I mean, since COVID, the market's been very weird. It's very manipulated in my opinion. It's definitely not the stuff you'll read in books, but as an investor, I think what we've seen here today is one of the best signs we could get as a whole. I think it means HIMS is building lifetime value and not just a transaction. You know, when you go to McDonald's, you buy something, it's a transaction. You go there, you don't go there because it's McDonald's. You're not friends with McDonald's. You go there because you're hungry and because it's McDonald's. But here you have a lifetime value, a connection with the company. And when you combine subscription retention with this rising average revenue per user, you get something every investor dreams of, which is compounding growth from the same customer base. We need Trump to tweet about how HIMS. It probably does honestly help him nightly. I mean, he doesn't he have like a 10-year-old kid or something. I don't know. They also, the main thing is they reported 78 million in adjusted EBITDA, which is up from 50. Where is it? I think it was up from 51. It was up from 50 million a year ago, and even posted the profit of 15.8 million. That's more than a milestone in my opinion. I think it's validation that the product works, and it's validation that the product is going to continue to work in the future. Cool channel, man. Thanks for the coverage. Thank you, Bob. I appreciate you hanging out with me if you're heading out, but I appreciate you. For years, people doubted whether this company could really be profitable or if any really telehealth company could be profitable. They said the margins were too thin, the costs were too high, and the trust. I mean, it's hard to build trust with. You're trusting a company with your health. I mean, we're obviously just investing money into this, but imagine trusting like people with your health. Obviously, there's FDA regulations and other stuff, but people are really, we're watching this happen in real time. We're seeing the model works. It's not just a concept, but it's a business. The margins have slipped from 79 to 74%, which I think will obviously be the margin. Not the margin. It will be the headline here, as well as the earnings per share. But I actually like that. It means they're investing in new categories, the marketing, the logistics, and they're also still scaling profitability. That balance between growth and control is what separates good management teams from just lucky teams that get good products. And it'll help in his new Epstein ballroom. A good South Park episode. Yeah, South Park episodes are pretty good. I wouldn't lie. And another thing that I think a lot of people glossed over. I didn't even hear I forget who does their financial analysis. The stock went down when he started talking, so I kind of ignored it. But people glossed over the fact that there is 148 million in operating cash flow, which is up from 85 million last year. That's literally a 75% jump in cash generation. And it tells me that HIMS isn't growing by burning money. It's fueling growth from within the company. To me, cash flow is like a truth serum. When you read a financial report, when you see the cash flow, you can adjust the earnings, but you can't fake the cash generation. And right now, HIMS is showing the kind of cash you'd see that puts them in control of their own destiny and this market in general. No dilution, no debt spiral, no dependency on the markets. So HIMS opened a small space across from my business in New Albany. back in 2022, and I left at that. Hey, there we go. You got live accounts of people affected by their misfortune with HIMS. No, okay. Um, for Q4, we've seen the management is setting big expectations, and I think with good companies, we're posting this conviction. We need big quarters in the future, and I think that matters more than any metric we've seen. Obviously, there is competition. There is risk. I won't lie. Margins could compress if they keep expanding too fast, but I think they're expanding at just the right speed, in my personal opinion. There is a lot of competition with the Amazon Clinic, RO, and several other niche startups that are chasing the same kind of market, but I wouldn't worry too much about it. And of course, one thing you want to watch for is regulatory oversight, which will hang over the telehealth space. No matter what you do, there's obviously going to be Uncle Ben, all the big guys over you, kind of making sure you're not doing anything too crazy and making sure everything's going all right. But my take is that HIMS now has brand recognition, profitability, and scale. That that combination makes it far more durable than all of its peers. And even though Amazon has this their name behind it, the thing is they don't have the product line. They don't have the customer base. They don't have what HIMS has. And HIMS is growing very quickly, and if they keep this execution as tight as it has been, I think these aren't existential threats. Excuse me, sorry. They're not threats. They're just hurdles that slow others down. Competition also brings growth. Of course, if we see more growth inside this business as a general, then the stock will grow in general. The stock will grow in general as the market grows. The total addressable market. What is the TAM for telehealth? TAM telehealth 2030. Let me look it up here on my screen. By 2030, TAM will remain a foundational. What is this? I'm looking for the total addressable market. What a waste. Did you meet Uncle? I did meet Uncle Sam. That is my best friend. My best friend Uncle Sam, who has been in my pockets every day. But so if I had to sum this all up, all this quarter into one sentence. If you gotta be paying attention right now. If you haven't been paying attention for the last hour, you gotta pay attention right now because I'm about to say something absolutely major. So make sure you hold on to your chair. Make sure you hold on to your couch. Whatever you're doing right now. HIMS has proved that growth and discipline can coexist. It is rare to see a company grow revenue nearly 50% while staying profitable, cash flow positive, and still invest inside of its future and its future products. And that's why this report hits different for me personally. It doesn't just show numbers, it shows a lot of growth and a lot of character by the company and the management. It's a company that's not chasing hype, it's not chasing headlines, but quietly executing quarter after quarter, which is what we like to see. And when you find that combination of growth, profitability, trust, focus, you don't just have a good quarter, you have a foundation for something long term. And that's why I think this is one of the best long term stocks right now. And that's why I think years from now, we'll look back at this quarter as the moment HIMS truly kind of arrived at the door and it's kind of starting to get its footprint inside of the market. So if anyone has any questions, I'd love to answer them right now. If not, I'll probably head off just because I don't want to waste everyone's time. How much people? 140 people? Oh, man. That's the most people I've ever seen in here. Thank you guys for hanging out with me. It really means a lot. Everyone who was here. I hope it wasn't too bad, the audio or anything. If there was any recommendations or anything, I'd appreciate you guys dropping them in the comments. Or if you guys enjoyed the analysis, drop a subscribe for me. It helps out the channel a ton. And in the future, I'll be doing more analysis. I know there's more this week I might be doing. If there's any you guys want, drop them in the chat or the comments below. Good job. Thank you, my friend. I really appreciate that. Enjoyed the show. Thank you, TD. Here the GOAT, my friend. Really enjoyed your thoughts. I have too many stock in $53. I wouldn't worry too much, man. Unless you're a trader, you gotta hold, man. You gotta hold, and if anything, you gotta buy more realistically. And Sag, voila. I thank you for your comment, man. I can't read the name, but thank you, Steph. I appreciate you for hanging out here with me. Um, Everyone, really, I really appreciate you guys. I know it's a Monday night. You guys could have been doing other stuff, but you guys took the time. You guys are doing what every good investor should be doing. It's watching the earnings report. It's listening to other people. It's listening to other stuff. You can just wrap your mind around as much as you can, and just continue to expand your thoughts. Continue to find new companies. And I think we got a good one here. Love it, Grit from Israel. It's nice to meet you, my friend. Yeah, Punjab. Don't worry, my friend. Everything's gonna be all right. I've had stocks where I was down 70% before, and then they ended up going. I was up by 15 times on them, and that's a personal example. I'll just bring it up for you guys. Just Rolls Royce. It's a company I bought at like $1.50, $1.60, and then it dropped to 80 cents. Like, and this was 2022. It wasn't even COVID anymore, and I held on. I bought a couple more, and now it's probably at $15 a share. Subscribed and like. Thank you, my friend. All right, guys. Have a great rest of your night. Be safe. Be good to one another. I appreciate you guys for hanging out. And take care. Be safe. And have a good one, guys. Peace.